My name is Andy Kurita, and I'm the founder and portfolio manager of Kettle Hill Capital Management. I started the firm in June of 2003, and I've been the portfolio manager since inception. Kettle Hill Capital Management is a long-short equity strategy focused on small-cap stocks. The key principles when we started the fund was, one, invest in an inefficient market. So small caps are inherently inefficient due to the lack of analyst coverage on both the long and short side. And we perform extensive due diligence and research on these companies in order to gain non-consensus outcomes and generate alpha. In terms of the management of the fund, I'm the portfolio manager and ultimate decision maker regarding trading. We have 5 analysts, each with their individual field of expertise, that provide me with information and data to make decisions on the fund. The key reason why I started Kettle Hill was to address what I thought was a shortage in the market. The firms that I've worked at in the past, I've worked at both a value firm and a growth firm, and I took the lessons from each of those places and adapted it to my own particular style that combines the risk-reward parameters of a value investor with the extensive due diligence and research that a growth investor is required to do on a weekly basis. We are running a long-short strategy to be able to protect capital. The core philosophy of the fund is to remain in a position of strength at all times. When markets are volatile, by employing a long-short strategy, we can protect capital. Therefore, when the opportunities are the greatest, we can deploy it aggressively on the long side. Since the start of my career, I've invested in small-cap stocks within a long-short framework. Our strategy is designed to generate equity-like returns with limited volatility through the course of the investment cycle. This is keeping in mind that the opportunity set is not consistent over time. Therefore, we have to protect capital when markets are frothy and be in a position to deploy it aggressively when markets are at troughs. Risk management is the fundamental reason why Kettle Hill has been in business for such a long time. We've been able to navigate the risks associated with many different markets, and my goal is for our performance to be the aggregated effect, cumulative total of hopefully a long string of good decisions. Some of those decisions will be right, some of them will be wrong. When they're wrong, we employ a disciplined set of risk controls to limit the damage to our portfolio. We manage risk on the short side by avoiding crowded trades, by focusing on liquidity, and having a system of stop losses in place in case the short goes against us.